Seaport Global initiating coverage in the financial space today, including Citi, Goldman Sachs, JP Morgan, Morgan Stanley, all buy rated. Liz, you do not like financials, though. Why not?
You know, I used to like financials, and I obviously work for a big financial. I'm an owner of financials. But if we look at the reasons why you would own this sector, number one, if you want to own it for price return, you're probably not going to have a lot of opportunity for that as long as the yield curve stays as flat as it is and as low as it is. If you want to own it for dividends, that story changed a couple weeks ago when we heard about limitations on dividends and some of the concerns over capital as we move forward and if this recession gets worse than we expect. So right now, in the near term, near to medium term, I don't think there's a ton of opportunity there.
That doesn't bother you, though, does it, Joe?
No, it doesn't. I think there's a couple of themes within the financial sector that allow you to allocate. First, private equity is going to remain strong. That could take you to a KKR or a Blackstone. I also think the trading environment is a very fertile one. That obviously takes you to Goldman Sachs. I am long Morgan Stanley because of the fertile environment as it relates to trading. I also like the E-Trade acquisition. I know a lot of people did not like that, but I think that's actually going to be a good one. You're seeing efficiencies, streamlining of cost at Morgan Stanley. The need for advisement has never been more emphatic than it has been here in 2020. So that's a trading positive. And then lastly, the exchanges. I think whether it's the NASDAQ, which I'm long, or CME or ICE or Virtu Financial, the exchanges themselves as the toll collectors in a hyper trading environment will benefit.
Jim, you own Goldman and Citi. Joe had mentioned a fertile environment for trading, and I'm wondering if trading is one reason why you own these two.
Well, they're different, honestly, but along with the trading environment, you got to remember that Goldman and Morgan Stanley have very vibrant wealth management platforms, and they also have very vibrant investment banking platforms. So they're not as tied to the yield curve as the true money center banks like a Citigroup. Now, with Citi, what I'm interested in here is as the economy has reopened and seems to be reopening faster than we thought on March 31st. This is important, okay? March 31st, Citigroup and Bank of America and all the big money center banks had to take loan loss reserves. It was a different environment then than on June 30th. I want to see when they come out with their earnings call, are they saying incrementally positive things about loan loss reserves relative to 3 months ago or incrementally worse? It's a little bit of a dicey situation there, but I think it's going to be better as opposed to worse.
And I wonder if we even get the real picture on that, Steve Weiss. I mean, when it comes to the extra stimulus checks, for instance, that goes away at the end of July. We might not have that data yet. There are a lot of unknowns when it comes to delinquencies and the need to put aside loan loss reserves. I don't know if the banks will have that much visibility this next earnings cycle. Do you?
Yeah, you know, it's funny. You're hitting all the negative views I have in the market. I feel like the Grinch who stole summer here. I'm actually pretty optimistic and enjoying life this summer. But let me say this about the banks. Wonderful companies, unbelievable management, but I just don't see, as Liz intimated, how you can make money in these, particularly with the possibility of Elizabeth Warren being Treasury Secretary. So I don't see it happening. It's too difficult. Joe's right about the fundamentals, trading, et cetera. But if you want to have exposure in the financials, maybe it is the private equity. For me, it's Visa, which is more of a tech company than a financial company. So I'm just not there, and I don't intend on being there at any point in time.